Hello, I'm Alex Mozed, and you're here on Winner Take All, where we talk about the constant battle between large tech monopolies and traditional incumbents, just trying to make sense of where all this stuff is going to net out. I'm joined by Nick Johnson, co-author with me on the book, and very excited to have our inaugural guest speaker join us straight from the EU, Doris Honold, the former Global Chief Operating Officer of Standard Chartered Bank. Doris, really excited to have you on the show today. Tell us a little bit more about yourself.
Hi, hello. Yeah, I'm here live from London, and I'm Doris. I have 25 years of financial services experience in very say traditional banks, traditional organizations. I had a lot of different roles in Frankfurt, London, Tokyo, Singapore, mostly in the risk function and chief operating function. And my last role was, as Alex mentioned, in Standard Chartered Bank, which is a British bank, but operating across 60 countries, mostly in Africa and Asia.
Amazing. And you're also on the board of Zopa, one of the leading peer-to-peer lenders, which we'll talk more about later on or in a little bit. But, Doris, I think just at a high level, it'd be great if you could, given your vast knowledge of banking, could you just explain to us, how does the actual loan underwriting process work, and what goes into all of that?
Yeah, I'll give it a go. No, because of course it's always, if you ask the question, it's quite different if it's a loan underwriting for an individual or a large corporate. But they're of course the same elements, and I describe it in three levels. And the first one is always kind of the strategy. So the bank really agrees, what is our strategy? Who do we lend to? What do we do? What do we actually know? And where do we want to be in business? Like one good example is that a lot of banks changed their strategy, given all the climate change activism, to not lend to coal companies, for example. So there are reviews of the strategy which right at the beginning say, that's a good idea to look at, or that's not a good idea. We just don't want to do that. The second level is then the risk appetite. It's quite critical that the banks decide upfront, that's the size of our balance sheet, how much do we want to allocate to loans? And then within this allocation, how much do we want to lend in specific countries and specific sectors? How much do we give to telecoms? How much do we give to real estate lending? And you already have quite a detailed framework. And then really comes the individual loan decision, the individual credit analysis, where you have a client coming with an idea and you really assess, and you in essence assess what's the probability of getting the money back. And if I look at what happened over the years, the biggest change and the biggest part of innovations has really happened in this credit analysis piece. These days, the algorithm used by banks are a lot more sophisticated. The number of data elements is a lot higher, because in essence the better your predictive power, the more likely is it that you're going to outperform your competitors.
Great, and I think that gets to kind of this trend of automation and using data in the underwriting process. This is a survey from 2012, which was surveying banks and where they are in the process of automating, different parts of the underwriting process. So from compliance related to different concentration limits and different portals for data gathering. And the dark kind of blue on the left is using it. The medium is don't use it, and then all the way on the right is don't know. And then this is from Elevate, which is a fintech lender, went public in 2017, I believe. And so it talks similarly kind of how they are using data, using automation to streamline the underwriting process, looking at credit scores, fraud scores, instant decision making on 95% of loans. This is an overarching, overgeneralized question. But if you look at the role of, say, banks' ability to automate and streamline and use data in the underwriting process versus the fintechs, how would you compare and contrast those two?
I'd say fintechs are probably ahead of it in certain areas, and I think a lot has happened in banks over the last 5 years, and that's really as a consequence of the challenge by fintechs. Because if you look at what the loan market is, there is no differentiation in product. It's not like buying a car or a house. In essence, you want money. So it's not different. The money is the same if you get it from this bank or from this fintech. What is the only two differentiation are the price, your loan rate, and the convenience. And this is really where I think fintechs have done an excellent job on both, like having more competitive pricing as a result of better models, and making it more convenient through easy interfaces. But of course, it's difficult. So fintechs have their pockets where I think they're definitely competitive and ahead of banks, and banks are reacting to that and investing heavily and catching up, and in certain areas maybe are on the same level or leading through either collaborations with fintechs, or in areas where fintechs are more tailored, and banks usually have a lot broader offering. So that's I'd say. But I think fintech, to their credit, have started a really good process where, in the end, the client is the winner.
Yeah, and that's a fantastic point. Being broad versus focusing on a few specific areas. And I think that's been a big challenge for a lot of the fintech lenders, is because very often you see them focusing on, say, a few industries or a few type of personal retail loans, whereas banks generally have just a much wider breadth of loan portfolio that they're comfortable providing. What are the main drivers as to why you see that shape up? Is it more just the banks have a larger balance sheet, they just have experience building the credit models across a wider array of industries? Is it that the fintechs just don't have the ability to have the models that scale across as large of a portfolio? Or why do you see that kind of more nichiness from a fintech lending focus?
I think banks are broader because historically they have been broader. I think it's really a big argument is the history. A big argument might also be that banks maybe have more of how to say that, social responsibility to cover the whole spectrum. And I think fintechs, of course, if you start something and you want to reach scale, then you have to be focused.
Yeah, I was reading an article that some of the big banks in the U.S., maybe it was Bank of America, that they actually don't make money on half of the retail loans they're issuing, and maybe it kind of gets to that. Maybe the fintechs are right to focus on some of the juicier areas, and the banks, whether for regulatory or societal or just that's the way they've done it, have a much broader portfolio, but maybe not as profitable of a portfolio. Yeah, that's interesting. So, what about, okay, so banks are lending this money. In the US, banks can borrow from the Fed, basically. They pay a 50 basis point premium. So if the Fed fund rate is like 1.75 to 2%, which is where it's at now, they pay an extra 50 bips, and then they basically just get to resell that debt. So they're kind of like just giant distributors of debt capital. You kind of think about it that way. And, I guess what, if you are a AAA, grade A kind of borrower, what are you getting debt at? Like 4 points today or somewhere around there, and so the spread isn't that large, but they're reselling this capital. I assume it basically works pretty similarly in the EU with the ECB, right?
Yeah, of course.
And then the next thing is, so then I think people understand that. Fintechs, however, don't have the luxury of borrowing from the Fed in that same capacity, right? And that's a regulatory reason, that they're not regulated like a bank, therefore they don't get access to, what is it, like the discount window or something like that? Is that all accurate?
That's the point. Whereas you see, at least in the UK, all these fintechs who started as a fintech very quickly got a banking license, and actually the UK regulator was fairly flexible in giving out the licenses, because they're still differentiating how do we regulate a big bank versus a tiny new fintech bank, and what can you do. But the whole motivation about showing that flexibility and making it easier to get a banking license was the idea that they like the idea of new competitors coming in. So it's the whole idea of competition is positive for the consumer.
And the impetus for a lot of those fintechs to get a banking license, right, is that it gives them access to basically a cheaper source of funds than if they don't have the license.
The other topic that you hear a lot about these days, but I don't think many people know, is quantitative easing. And so I'm going to take a stab at how I would describe this, and then you let me know how I do. So my understanding of it is that, so if you're a bank, the Fed and the central bank, so the ECB in Europe, would say you as a bank have to hold certain amount of cash reserves on your balance sheet, and they can lower or increase that reserve amount based upon what the Fed wants to do in terms of maybe increasing or decreasing the amount of lending that banks are doing, right? So if they have to keep more cash on the balance sheet, that leaves less capital that they can lend. Now, quantitative easing is that they could keep the reserve requirement the same, but what the Fed can do is say, we're going to buy marketable securities, or we're basically going to buy loans from you, bank, and now you're going to have essentially more cash. You're going to have a more liquid balance sheet, which now opens up more capital for you to go and then lend that money out to other either retail or commercial borrowers. So far, so good on that?
So far, so good. Yeah, it's the whole point is just to generate liquidity for banks to lend out, to bring more money in circulation.
Now, the interesting thing is when the Fed does this, they just do it. They just make up the money. The money just appears. It's kind of like they're a genie and they snap their fingers and boom. Okay, I just bought $100 billion of your debt, Bank of America. Okay, there you go. There's $100 billion. But the interesting thing is that the money never actually transfers to Bank of America from the Fed. They're just kind of, it's really an accounting thing where now
ones and zeros in a computer.
Yes. Now the Fed says, oh, well, you have $100 billion. I'm just making up the number of more liquidity because I have, acquired these securities from you. So all of that's very interesting. So it's just another way, it's another mechanism to, as you're saying, either increase or decrease liquidity. The interesting thing about it is it's not as hard-coded of a metric, right? It's not saying, here is the reserve requirement, here is the Fed funds rate. It's kind of this more amorphous activity that you either know that the Fed is doing this or not doing this, but it's not as measured as saying, as the other metrics. So it's not as clear to everyone the degree of liquidity or lack thereof that's being created by the central bank. So that's really interesting. Let's go a little bit more into the fintech lending landscape, and let's start with Zopa. So Zopa, it's a very interesting company, probably the leading peer-to-peer lender in the UK and in Europe. You've been on the board there. How would you describe what Zopa is and what makes it so great?
I think what Zopa is most proud of is that they're, I think, the first peer-to-peer lending company in the world. So they really started 14 years ago. And so therefore, they're also a fintech or peer-to-peer lending company who has been through a credit cycle and who are still around. So that's proof point that even fintechs can survive a credit cycle. I think if I would describe Zopa, I would describe it as what's the and Zopa, by the way, also just recently got a banking license. And their vision is really, if you look out there, then there are a lot of people who are stressed about money and who think managing money is just painful. And they basically want to create a space where managing your money is easy. It's actually fun. So that's why all they're doing is, what does it make? What is it that it makes easier for clients to manage their money? So that means not using any jargon. That means transparency on your pricing, no hidden fees, etc., etc. So, for example, if you go on the Zopa webpage, you want a loan, they give you, they say you will get the loan and this is the rate, and they tell you that before you officially apply for the loan, and that just makes you feel in control, because it's very disturbing if you apply and then you get like a ridiculous rate, or you get declined, and it might impact your credit score, etc., etc.
It's geared towards the retail investor, right? Looks like personal loans, car loans, other things like that. So very cool company. Now, I found this graphic. I was at a lunch with Anna Boten, the executive chairwoman of Santander Bank, on Monday, and she was saying, well, fintech lending is much higher in the United States than it is in Europe. This is from 2017. It shows about 36% of the personal loan industry. So this isn't everything, but a good indicator that fintech lending is certainly on the rise. Banks actually have only about 25% on this chart in the US. But what she was saying is that in Europe, the spread is much different. Banks actually still have a majority of lending, and the kind of the ratio is somewhat inverted. Well, assuming that's true, I guess, why is that the case? What would you say is different US, Europe, as to why you see banks having a smaller portion in the US versus Europe, or fintechs maybe having more penetration in the US than in Europe? That's
interesting. And I probably read the same article Anna read, which was in the FT, and I was surprised as well to see that fintechs, with respect to lending, really haven't really grabbed a lot of market share in the UK. What are the reasons? I think there can be a whole range of reasons. One could be timing, that it's too early. For example, Monzo, a very successful UK challenger bank, has only recently started to offer loans. So their focus was first on making the whole payments, money management easier than giving out loans. So with Monzo, I guess it's definitely a timing issue. So we'll see. I mean, I read something interesting about the UK fintech lending space, which gives us a slightly different angle to it, and which is I read that in the US, that in the US still a lot of people the first stop is at traditional banks, and if they get declined by traditional banks, they go to challenger banks. So kind of indicating that challenger banks get a bigger share of the pie, but maybe also more risky or lower credit scores. So, I think it's probably worth having a more detailed analysis on this, but it's definitely a very interesting fact.
Well, and that's a great point. And actually, so this article is a little bit older from the FT. It's from 2015. And it talks about Metro Bank, which is a challenger bank in the UK, partnering up with Zopa and providing loans on Zopa. I'll come back to that in a second. But to your other point, it also says here that Santander and RBS did a partnership with Funding Circle. Different partnership where they're basically saying, hey, we can't lend to you. So here's this group called Funding Circle. And I'm sure Funding Circle is kind of paying like a referral fee or something like that for essentially those rejected borrowers in this model here. Now, what is more interesting, though, is that to me is kind of like a lending marketplace 1.0. That's kind of like what we've seen in the other direction with a lending tree or a Bankrate in the US, where they're saying, hey, I'll connect you to a variety of different borrowers. It could be banks, it could be fintech lenders, and then they collect a fee from the lenders to make that introduction. I'm sure that's kind of similar. What was very interesting in this article was the description of now, this is now a number of years ago, Zopa going beyond just what you would consider peer-to-peer. And peer-to-peer would imply individuals are lending to other individuals. But this was, I think, probably the first case. I think they have some other partners now that aren't necessarily all banks. I think there's some funds that are doing this, but where they're now getting institutional money to come and provide capital to the Zopa borrowers. And I think this model is really interesting, and I would imagine is working pretty well for them. Is there any other context that you can share on that?
No, I mean the way I look at it is that Zopa has built, might be a very successful peer-to-peer lending platform, and there are other players out there, Metro Bank or other funds who have excess liquidity, and peer-to-peer, an individual investor who likes the platform as an investment, that's an interesting way to deploy excess liquidity. So and for Zopa, they have a mix between funding from individuals and funding from institutions.
Mm-hmm. Now, what's interesting, though, is Lending Club, which started as peer-to-peer. A lot of people have criticized Lending Club because now there's the peer-to-peer lending side of the business has actually declined a lot, and it's more so gobbled up by just a handful of large banks and institutions. I see that model with Lending Club as being different than Zopa. I see Zopa working with institutions, but not the kind of incumbent banking institutions that Lending Club is working with. Is that accurate, Nick? Would you say?
Lending Club works with a pretty broad swath, including a lot of the big institutions, Goldman, hedge funds, big banks.
And I think what's interesting here is the difference between a personal lender, where Zopa says, hey, let's say Alex is applying for a loan. Here is the credit risk. I think they have ABC. They have different grades they're going to provide to my application. And then they are associating that with a certain level of interest rate that then they are now letting individuals lend to really a portfolio. So If I'm a lender, I put in $10,000, they might split that $10,000 across, let's say, 10 loans. And me as the lender, I can pick what risk profile I want for that basket, and so on and so forth. The larger institutional lenders here will obviously need to put much more capital to use, so they will provide the whole loan, say, to me. But what is interesting, I think, and this isn't, say, Zopa specific, is when you have institutional lenders that can now start to put larger sums of money to work, that can use the data, that can have their own algorithms. Do we see a model where those institutional lenders, the platform could still say, here is what we think Alex's risk rating is. Here is all the data that Alex provided about the loan that he wants and his credit profile, so on and so forth. And is there a way where we can have these lenders compete over my loan? And let's say one lender is now, they are creating their own interest rate to suggest what they would lend to me at. Maybe one says, well, I'll give Alex 6%. And one says, I'll give Alex 5%. Is there a way that you can now centralize these transactions and kind of put a forcing function on the lender base to do that competition? Is that a direction you see the industry going? Is it already there?
No, I mean, of course, that can happen, and of course you can look at it both sides. Now, I'm not sure if Alex is a good example. I guess it depends on the size of your needs, I guess. But the point I'm making, it always depends. If there is excess liquidity, which as a result of too much quantitative easing, yes, then they're going to all compete about Alex's loan. If there's not enough liquidity around, you will have to shop around and see who will give you the best rate. So it's, it can turn around, but you're absolutely right that with platforms, a scenario where lenders compete about giving, being able to give you the money is realistic and feasible, and it wasn't 10 years ago.
Very interesting. And now we went full circle here. So you're mentioning Zopa's been around for 14 years. It's gone through a credit cycle. And as you're saying, look, the central banks really are able to exert so much influence over just liquidity and the lending dynamic. I think they're back to quantitative easing in the US. I'm not I should know that. But there was tightening and whatever. But yeah, I think that is the biggest knock that I hear from the skeptics about the fintech lenders is that, well, everything we've seen here has happened in kind of a bull case scenario. They haven't seen a downturn.
Historical bull market, of course, they're doing well.
Right. And well, that's all going to get turned on its head if and when we have a downturn. Maybe some of that's true. Maybe there are some people that are a little overextended, taking on a little too much risk. But directionally, I wouldn't agree with that. I have a little bit of bias, but you're from the industry. What say you?
I never like blanket statements. So if there's a downturn, will there be some defaults? Yes. Will there be some defaults from startups and fintechs? Of course. But that's kind of if you look at the the money, venture capital funds, the other lenders have put into startups and into fintechs, it's amazing. So there was really suddenly this huge amount of money which people were very happy to give away to new ideas, to challenger banks, challenger whatever. And of course, if you are in such an environment where everybody is kind of in this rush to find an opportunity of a new company to invest in, there are situations where you get carried away, and maybe there were a few investment cases who weren't as solid as they looked in the heat of the moment. But I don't think that's that's a function of, fintechs not being thoughtful or professional or having excellent people who know how to ride out a storm. Like always, there will be some winners and some losers.
Yes, very true. We'll just see if the winners can take all, right? But anyway, sorry about that. Doris, thank you so much for joining us today. We hope to have you back again soon. Have a great rest of your afternoon, evening in London. Thank you.
Thanks, Doris.
Great. Well, that was fantastic. Let's shift gears. Let's get away from the banking stuff. Let's look at boxing. And I think I'm pronouncing this right. I think it's called DAZN. It's DAZN and it's kind of separated. I think it's DAZN. Otherwise, I don't think it's, you call it DAZN or DAZN. I think it's DAZN. Clearly, I've not subscribed for it yet, but it is very interesting. What is it? For $100, you can get an annual subscription to DAZN. And you can see, look here, October 5th, you could have just watched Triple G. I know that name. I've heard of Triple G. Canelo, I've heard of Canelo, November 2nd. These other guys I think are very popular as well. Full disclosure, I'm not totally familiar with them, but from what I've heard from my friends who are into boxing, this is a fantastic deal. Why is this such a good deal? It's such a good deal that, well, certainly the promoter who helped ink the deal says that pay-per-view is dead. This article is refuting that. Where is this guy? Golden Boy Promotions. I love the names of these promotion companies in boxing. So Golden Boy Promotions, Oscar De La Hoya. I've been all over New York City this week and felt a huge buzz. On December 13th of last year, he said, and I want to start by saying, ladies and gentlemen, pay-per-view is dead. I'm actually happy to announce that pay-per-view is dead. The guy has a little bit of bias because he's inking deals with DAZN, but we'll disregard that. This article says, well, it's not completely dead, but it's certainly going to struggle. And that I would agree with wholeheartedly. Here's why. Let's just look at the numbers. Basically, pay-per-view, if you watch each one of these fights, it starts at like $75 per fight.
It's not cheap.
So this Pacquiao fight, $75.
That you get the whole card typically with that. So it's not like one fight. There's a bunch of lesser fights that come before that. But when people were buying the pay-per-view, most of them are buying it for the titular fight.
So, HBO is charging $85 per match. So you pay $100. And so now what DAZN is doing is signing key kind of all-stars like Triple G or Canelo or these, I'm sure the other guys on there are all-stars as well, but they're signing these big tier boxers and then is packaging this up into a subscription model. And they're doing a lot of fights. And so pay-per-view just charges so much money that, yes, they are going to be in a lot of trouble. Maybe they can go get, one-off matches with key boxers, but it's
the
going to be
Netflix
tough.
factor here too, where you had a lot of people were worried about the rise of illegal streaming or torrenting of content, and no one would ever pay for TV again. Turns out they would if you made it convenient and put it at a reasonable price. $15 a month or roughly that for Netflix. And now for boxing, it's the same idea. There's a lot of people. There's been a huge rise of like illegal streaming of boxing matches because people just don't want to pay $75 every few months or every month or whatever, however frequently there's a big match. So this basically says, all right, we'll give you $100 a month. Still not cheap, but compared to the current price or the historical price in the market for boxing, great deal. And we'll give it to you convenience. You can watch it however, wherever you want. And I imagine that's similar to Netflix, pretty effective for this target audience, and just saying let's make it simple and seamless and put it at a reasonable price, and people will pay for it.
So what's interesting is what is the genesis of DAZN, right? If you go on Crunchbase, it doesn't really tell you much of anything. It doesn't say that they've raised any money. Basically, this is a JV. This is a spin out. It was spun out by Perform Group, which is a sports media company majority owned by Access Industries. So if you look at what Access Industries is, it It's basically Len Blavatnik, billionaire. They own a variety of different things. One of the things that they owned was certain television rights, and some of that was in the boxing arena. So he kind of seeded this, got this going. He also owns part of like Warner Music Group and all these things. So he got this going. It started in the UK, and then I think came to Canada. And then in May of last year, 2018, they announced they're coming to the US. They got the former ESPN president, John Skipper, as their executive chairman. And then they started making deals. So basically, Len and Access and all of that are seeding this with capital. They're now getting a lot of subscriptions to help offset that, but they had to ink and put out a lot of capital to do some of these lockups. So they started doing deals with Sky Sports box office, this Matchroom Sport. They did a deal with Viacom to get access to their promotions boxing group, and then also get access to all the events televised on Paramount. So they're doing deals, right? They just did a deal, they did a deal in October of last year with Canelo, an 11-fight deal valued at $365 million. And he had just done a fight maybe a month or two before that and you could have paid, I don't know, $85 on pay-per-view for it. Now, here's the thing. The pay-per-view companies and the middlemen were taking so much of the money from the boxers. So the other thing that I think DAZN has done is help to cut out some of the middlemen, cut out a lot of these different players, go directly to some of the key talent and lock them up. So yes, it's kind of like the Netflix for boxing. The difference is the supply is actually a lot more limited, and you can lock them up. I actually like this business model much more than Netflix's business model. Because
if you get the supply,
yes,
then it's hard to compete against it. You can basically effectively create a monopoly by if you're doing it. Obviously, it's not going to be cheap, but there's a lot of people that make content out there, so it's a little bit harder for Netflix to do that without bleeding any more cash than they already are.
And now the interesting thing is they're starting to get into other sports. I think they're starting to do rugby internationally, and other, I guess, less like primetime sports. It might be a little bit harder to watch. They can probably get them on the cheap, and now have a kind of multi-tiered subscription package. I think it's a very interesting model. I think sports is the one thing that's keeping cable TV alive. And if pay-per-view boxing was their back door into the industry, and they now have the subscription model, and they now, why won't they go get like the soccer league in the US, right?
I think Bleacher Report in the US has the Champions League games, and they have, if you go into their app, they'll say, hey, well, come watch the Champions League game, and you can stream it. And they have, I think, a subscription service, so you can pay like a la carte, like I'll pay $3 to watch this match. So that kind of competition is already happening. And yeah, I think you have a lot of these big licenses for the major domestic leagues coming up in the early 2020s. And it'll be interesting to see how that shakes out. And along with that, you have a lot of these lesser popular sports, particularly in the US. Soccer is still not as big a draw as, American football, basketball, these kinds of things. As well as these kind of more niche international sports. Things like cricket in the US would be another one, whereas that's huge internationally. So if you can get these entry points in, I could definitely see them building enough of an audience where eventually they're able to compete for some of these bigger sports licenses.
Yeah. And that will be the nail in the coffin for cable TV as we know it. I mean, that's it. That's really the thing propping them up.
You've also got competing with them, though, are the big sports companies. Like ESPN has their ESPN Plus service, so they would be competing against them for rights to stuff, I imagine. Yeah. But again, that's taking something that used to be huge for cable, live sports. ESPN was a big part of that package, and now you can get it for $5 a month, or if you bundle it in with Disney Plus and stuff, you can get it for even less than that. Yep. So that cable bundle is starting to unbundle and pick apart, and the cord cutting is definitely going to accelerate, I think, in the next 3 to 5 years as a lot of these streaming services really take off.
So, let's go back to China. in a positive light. We were a little down on them yesterday. But, look, there are a lot of really great things going on in China as it relates to platforms, even though the Chinese government is abusing that power. And Tencent, even though they have kind of been a part of that, of late, so they're putting $500 million into this Chinese drugstore brand. But to note, they've also done a lot of other things in healthcare. They have a kind of marketplace for doctors, a healthcare network.
They have
telemedicine with remote consultations. They're providing their own health insurance model.
Yep.
They're getting access to the medical records. They're putting AI on top of that. It's very, very cool what they're doing. Basically, I'll say this, full stop. Chinese tech platforms in healthcare are miles ahead of what's going on in the United States. And it's a big problem. There's so much regulation, as we've talked about. It's the regulation. It's incumbents locking up data with or without regulation, using regulation as an excuse. The incumbents are able to lock up the industry and just kind of undermine innovation through this kind of quagmire of consolidated payers in the US, where the money is controlled by 5 parties, the insurance companies. And it's very difficult to break into healthcare in the United States. In China, there basically was no incumbent healthcare infrastructure.
Well, a lot of it was, there's a basic minimum standards of care provided by the state, but there's a big shortage of doctors, so it can take a very long time to get things that you need. Not necessarily convenient. So there's a lot of challenges with healthcare in China, and into that vacuum, basically, these tech platforms have basically stepped in and said, all right, we're going to do what we did to other industries. We're going to introduce a platform. We're going to create a network. We're going to suck out a lot of the transaction cost, make it more convenient. So now you can get on the phone with a doctor or do a video call rather than having to go in there, and that makes it a lot easier for a lot of these low-hanging fruit, like, oh, my kid has a flu and I want to get feedback on what should I do. He's a fever of 102. Things like that is stuff that can very easily be handled over telemedicine, and a lot of the barriers, particularly insurance, has a long time been a big barrier to that in the U.S. Taking off don't exist to the same degree in China, and they've really done a good job of providing this whole ecosystem of solutions.
Yep. China also has a great example in healthcare of a large traditional enterprise spinning out a very successful platform in healthcare, which is Ping An, the insurance company, spinning out Good Doctor. Ping An has gone on. Good Doctor is basically a marketplace, a services marketplace for in-person visits, remote telemedicine visits, and now they centralize your EMR. They centralize that electronic medical record. And now they're opening that up to third-party app developers who can create software for the consumer, for the physician. They're providing, they can help clean up a lot of the data in the database that you're using. It's such a great example about how platforms can provide so much value in healthcare. It's a really good North Star that a lot of the companies in the US can, and I think some of them are looking at. Ping An has gone on to actually replicate this model in financial services, and they've spun out another very strong fintech platform, which we spoke about a few episodes ago. So let's go to Apple. Apple merged. They'd spoken about this. So their target is by 2021 to have iOS and macOS basically be ubiquitous, in the sense that if I'm an app developer and I make an app for the iPad, that app will magically work for the laptop, for the Mac OS.
Right. So they've created this tool that at the moment is what it's supposed to do. Catalyst is that if I have an iPad app, I can basically use Catalyst and go through a checklist to convert it to the Mac, and then all of a sudden it's available on Mac OS laptops, desktop computers as well. But there's some challenges with that, right?
Yeah, and basically this article is saying the developers are saying it's not really working right, yada, yada, yada. I think that's fine, right? I mean, if the goal is 2021, you got a lot of time to figure that out. We got over a year here where if, they're going to do this in cycles, this is V1, I get it, makes sense. The big problem I see with this is the last little 3 words here. Users paying twice. I think this is really interesting. So it makes a lot of sense for Apple to do this on the supply side, on the producer side, where now if I'm a developer, I'm now able to just bring more inventory of apps to the desktop, to the laptop. And so, if you look at the App Store, it was predicated on the smartphone and then on the iPad. And that was clearly the main driver, that network effect, that differentiator to make that platform model extremely dominant and basically why Apple's almost $1 trillion company today, right? Their market share with the Mac OS is much, 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 much lower compared to Windows. And so this has always been an area where, if I'm Apple and you say, oh, well, what if I could bring the scale of my app ecosystem on smartphones to my computers?
Right.
Because there are a lot of apps that just don't exist for the Mac because there's just a smaller demand base on Mac computers versus on Windows. And so this could be a great way where they leverage the scale that they have on the smartphone iOS app ecosystem and can bring that supply side scale to the Mac OS. Strategically, it makes a lot of sense. This thing, though, I'm not really sure about. I don't think Apple has really kind of figured this out, where you say, oh, okay, well, if the app is being magically ported to my desktop, should I have to pay twice for that?
Well, I think part of the reason that exists now is the magical part isn't quite there yet. So there's some effort involved typically in making this actually work well. If I'm an app developer, the challenges, as they mentioned, so the checklist kind of feature, it's supposed to be like, all right, it goes over, but there's a lot of things that are different from a touch screen to a mouse and keyboard kind of form factor. So if you're actually going to do something well, there's a little more investment that goes in it today. I imagine if that eventually gets smoothed out and it really becomes magical, and it's easy to port over, that double pay model goes away. But I think for them to get some initial supply and at least incentivize them, all right, you guys, you can get more money if you do this rather than, it's just more convenient for your users. It makes sense. And I think it will motivate more developers to do it in the short term. I think long term, that double pay model is probably or almost definitely going to go away.
Yeah, I think this is a good example where, how could the platform help put some standards around pricing? So, when the iPhone first came out, I think the cheapest app was like $1.99. It wasn't 99 cents, right? Or was it 99 cents? I think it was more. I think it was at least $1.99. They put a floor, platform enforced floor. So I think what would be interesting is if instead of leaving it up to the developer, where now kind of the developer could be made out to be the bad guy, where, yeah, I'm deciding to charge you twice, even though...
Right. There's a lot of negative feedback that this article mentioned of developers saying, hey, I already bought your app. Why are you trying to make me pay for it again?
Yes. So I would say, like, if Apple just says, hey, there's a 30% premium or additional fee, for example, if you are using the app, or if you want to unlock this app that you already bought on the phone and now you want it to work on the desktop or something like that, right? It's still a discount compared to what it used to be, but there's still a little bit more incentive for the developer. This, to me, from a pricing standpoint, is a place where the platform should help to step in until the market normalizes and you have a little bit more
supply.
Yeah, you have more supply. You just have more kind of, the users just have a strong, a given expectation about how this should work.
Right.
It's kind of the no man's land right now. And you don't want developers to suffer. This is supposed to promote developers to adopt this and bring more supply. So if you can help standardize some of the uneasiness around pricing, always a touchy subject with consumers, that takes a lot of the onus off of the developer. So that's one thing I think if I was Apple, I would move much more quickly on this paying part of the equation, and the development stuff will eventually work out the kinks. So lastly here, we've spoken a lot about real estate marketplaces, Zillow and Redfin, both in Plaid, the ETF. And I really like this modest proposal. Fellow or who knows, lady on Twitter and he's talking about an interview, or the Modest Proposal is talking about an interview with Rich Barton, who is the CEO of Zillow. And basically what he says is Zillow didn't have a choice. Opendoor's offering. Opendoor, we've spoken about before. Basically, they buy homes. They say, hey, I'm going to give you an offer for $750,000 for your house. They use big data to
price it,
and then say, okay, I'm going to buy, if I can buy this thing for $750,000, if I put $25,000 and work on this house, then I should be able to flip it for $850,000. And so they've got these algorithms and these models that are now proactively, out of the blue, giving offers to people to buy their house. Kind of an interesting model. Basically, Opendoor is valued now more than what Redfin is. I think it's around $4 billion valuation, maybe $5 billion. It's close to what Zillow is valued at. I think Zillow is around $6-ish billion. So this is a linear business, though. This is not a platform business. So it's very capital intensive. You're buying stuff and then flipping it. But the whole model is that they can use data and algorithms to find opportune buying opportunities and then flip them for a good price, right? So the CEO says, we saw this coming, this instant buying, this phenomenon. It was an existential threat because if it works and we don't do it, we get displaced as the marketplace theoretically. And so, he says here, Barton is also on the board of Netflix. And so he's kind of hearkening it back to Netflix kind of upending the entertainment industry, which is more correct than the marketplace example, right? So this is kind of a linear business coming in and laying waste to how home buying has been done forever, basically. Barton is also the co-founder. He co-founded it about 14 years ago. And basically, Zillow has decided to roll this out organically. And they're losing money trying to figure this out. So they lost $72 million in the second quarter of 2019. And what Barton's saying is we didn't have a choice. And this is an existential threat. We had to do this. We had to figure this out. Now, what's interesting is that Barton founded this company. He'd been running it for over a decade. He didn't see this.
Yeah.
Opendoor got pretty big before Zillow got around to doing this themselves. Redfin has partnered with Opendoor. There's probably going to be a merger we predicted there. Actually, probably Opendoor consuming the platform, interestingly enough. And I think that's one of the interesting models in these really large ticket product marketplaces. Highly infrequent purchasing, right? So I buy a car. I buy a house. How often do you do that, right? So there's really very little, if any, stickiness on the consumer side. You keep coming back
right,
and back again. It's really all on the supply side.
Big one-off purchases.
Big one-off purchases. That's why the Zillow work with the brokers and the real estate agents. Cars.com work with the dealers.
Yep.
So you have just such a stronger affinity towards the supply and the producers where you do have a lot of repeat business. And on the consumer side, it's much more transient and you have very high CAC to get these customers. And so you actually see these car marketplaces and these real estate marketplaces just having difficulty to have the same winner take all dynamic that you see with some of the more, I would say, like 2.0 type of marketplaces where the consumers have a lot of repeat usage and you have a lot of stickiness on both sides of the ecosystem. When you have less stickiness on one side or the other of the ecosystem, then you naturally kind of see just less consolidation of the network effect on both the buying
the network
and
effect
supplying
isn't
side.
quite as strong. So there's the ability for more people to compete. You can get sufficient enough supply that you can make an offer to a customer, then you can basically just compete on ad cost.
Right. And that's the interesting thing in these models, these linear buying and reselling models, whether that's a Carvana on the car side. I'm pretty sure I'm referencing the right company here, Carvana, which will buy your used car, fix it up, and then resell it. And similarly, Opendoor on the real estate side is the platform now should have a competitive advantage to do the linear activity of buying and reselling because it has the widest access to data and it has the broadest network of coverage. Hence the Opendoor Redfin partnership. So, really interesting space here. We'll see, can the dominant platform in real estate organically compete against the Opendoor upstart or not? We'll see how this kind of goes. If this tips the scales.
Going back to the downturn thing too, I think you have a company that has a business model that works fantastic as long as the market's going up. You can take a house and you can price it, based on current price levels and say I can flip it. But if you have a bunch of these that are sitting on your balance sheet and all of a sudden housing prices collapse, what happens? Not saying that's about to happen, but there is some skepticism about Opendoor's model in a downturn. Because unlike a lot of these fintech companies, they do have huge assets that can, have a lot of downside to them. Basically, in a downturn, even to a greater degree than loans do, and a lot of these fintech companies also don't hold those on their balance sheet. Yeah. They're just marketplaces.
Yeah, great point. Founded in 2014. This is kind of weird. Keith is a VC. He's listed as a founder. Guarantee he wasn't an operating founder of this, unless I'm completely missing something here. Pretty sure he's been with Khosla Ventures for a long time. But yeah, interesting. VCs counting themselves as founders. He co-founded Opendoor. I don't know. It's on his Wikipedia.
So it must be true.
But he joined Khosla in 2013. How did he co-found Opendoor in 2014? I didn't know about that one. I don't know. It sounds maybe like a founding investor. No offense to Keith. I like what Keith, but I don't know. I just would consider a founder an operator.
Someone working on the business full time.
Yeah, it's interesting.
They've done well for themselves.
Yeah, I mean, yeah. All right. Keith finally, I guess maybe he incepted this. Khosla Ventures, he finally launches his real estate startup. I guess this was his idea. He assembled the team. Yeah. Interesting. He said Peter Thiel gave him the idea.
The level of integration you don't usually see in VC, where not only we're going to fund it, but we're going to build the team to fund it.
Yeah.
Interesting.
Yeah, it's actually very interesting. Peter Thiel, my friend Peter Thiel, suggested I come up with an idea to innovate in residential real estate. It's the largest part of the economy, unaffected by the internet, and that was definitely true then, and even with things like Trulia and Zillow, it's fundamentally true today, but the process of selling a home hasn't been transformed by technology. Interesting. Okay. I guess he's the founder and kind of concept originator of Opendoor, disrupting the real estate industry. So good job, Keith. Very interesting model. Well, that's it for us today on Winner Take All. Thanks for joining us. We'll talk to you tomorrow.